Hello and welcome to the Morningstar series, Why Should I Invest With You? I'm Emma Wall and I'm joined today by James Anderson, manager of the Scottish Mortgage Investment Trust. Hello, James.
Hello, pleasure to be here.
So firstly, congratulations for winning the Morningstar Analyst Outstanding Fund Manager of the Year. It was in part due to the performance, but also to do with the process. And I thought we could talk today about your approach to markets, because I think it's quite interestingly contrarian insofar as valuation metrics that most people use, you don't think are particularly fit for purpose.
No, we don't. And it intrigues me, Emma, because I think the period for which the traditional metrics, or at least the default metrics such as PE on immediate earnings that people use, have really not been explaining markets and companies for a very long period of time. That may be even more acute in some of the areas that we happen to invest in. But if you think about it, if you're Jeff Bezos, you aren't trying to generate earnings for this year. It's about the decades to come and lifetime consumer values. So I think it's logical that our valuation stresses those long-term categories. And, you know, I find it quite irritating in many ways because lots of people say, we don't care about valuation. We think we do. We think we are looking at the right valuation, which is probability-adjusted long-term cash flows.
And it is incredibly difficult, though, to have the scope to forecast the growth that some of these, in particular, tech stocks have had. So before the camera started rolling, you named, for example, Amazon and Tencent and said, if you'd rolled back time, would you have been able to envisage the behemoths that these companies have become? How do you do that now, then? How do you ensure that you're getting these judgment calls right?
Well, the first thing is that we try very hard to focus on that, because I do think there's a huge behavioural issue in fund management that, you know, all the behavioural finance studies show that people dislike loss much more than they enjoy gain. But I think they underestimate how much that's so for a professional fund manager who is constantly berated for making mistakes. And at the same time, we live in a world where, in fact, equity returns aren't really explained by the normal company. They're explained by the huge outliers. So we try and spend a lot of time in our valuation trying to work out what the top 5% of outcomes is. So you're not saying it's going to happen, you're saying it's trying to happen. But even given that, frankly, your two examples are extremely good ones, Emma. We didn't get close to understanding the degree of opportunity in those companies. Understanding how great a great company can be is truly difficult, but fabulously exciting because it focuses you on the opportunity.
And the other thing that we were talking about earlier is the idea that focusing less on markets as a whole and actually understanding the importance of just individual stock performance, because if you're not invested in the whole of the market, it doesn't really matter what happens there.
I think that's right. We were terribly influenced by a paper written by Hendrik Bessenbinder entitled "Do Stocks Outperform T-bills?", which the obvious answer is no, because actually your returns are dominated by a very small number of companies, and it's trying to identify which ones have the possibility of greatness that matters. And the oddity around that is that, to be honest, you can still be quite diversified and not capture any of these stocks. And I think that is the lesson that really the markets need to think about much more. And, you know, I still worry that there is a misperception about where returns come from, driven by, as you say, this concept that it is an asset class that delivers the returns rather than individual companies.
James, thank you very much.
My pleasure.
This is Emma Wall from Morningstar. Thank you for watching.